All right. Hello again, everybody. This is Mike Rixey. I'm the lead options instructor for NetPicks, and this is our weekly options recap. Wanted to come on and highlight some of our trading from this week. We had a very active couple of days here this week. It was a holiday shortened week, but a lot going on here. Considering the market wasn't ultra active here this week. We didn't have a lot of big volume, but there's a lot to do with our options trade. So we'll highlight some of those trades here over the next few minutes. And then we'll also take a look at what we're expecting for next week. I think we're at a very crucial point here in some of these index products. And I want to walk you through how we plan on trading next week. We'll talk about some trades that are on our radar for next week as well. Some new trades that are potentially setting up for us over the next couple of trading days. As always, if you have any questions throughout the session today, feel free to type those in to the chat box, and I will get to those as soon as I can. If you are watching the recording on Facebook or in YouTube, feel free to send me an email directly, mike@netpicks.com. I'm more than willing to get back with you there as well. So let's start out by talking about the daily chart of SPY. This is where I typically like to start all of my sessions, because it just helps paint a picture as to how strong or weak the market is. It helps guide me in what types of trades I'm looking for. Am I looking for long calls, long puts? Am I looking for debit spreads or credit spreads? And am I looking to use more weekly or monthly options? I'm not necessarily using this chart to base my entry and exit points off of. It just helps guide my level of aggressiveness. So looking at the chart of SPY, and try to make that as big as I can here. Easier for you guys to see it. So over on the right-hand side, you will see the solid pink line there. That is our 8-period exponential moving average. Notice what's happened here for the last 3 days. We have tested that 8 EMA for 3 days in a row now, and every time that we've tested that level, it is held as support. That is our key line in the sand. We've had some back and forth movement here today. The NASDAQ is weak. The Dow and the Russell are strong. So we've kind of got this tug of war going on here. But it's not going to lead to anything significant on the downside unless the S&P, unless SPY can break through that 8 EMA. We're going to continue to see more chop. And we could potentially see a push back up to the all-time highs next week. So very key point here going into this afternoon, into the close. That 8 EMA is currently sitting at 390.37. That's the level that I want to see broken on a closing basis. It's not enough just to break it intraday. We saw that yesterday, right? Yesterday, midday, we were seeing some selling pressure below that level, but we rebounded and we closed up above it yesterday afternoon. So want to see a close below that level here. If we do get that, there's a nice little air pocket down to the 20-period. Exponential moving average, and the simple is down there as well. Right around the 385 to 385.50 range would be an area of support, but we've got some room there to maneuver if we start to get some follow through on the downside. The market is still overbought in the near term. Again, a lot of talk about more stimulus and a lot of talk about the S&P heading up to 4,000 here over the next few weeks. That very well could happen. But from a pure technical perspective, we have a lot of stocks, a lot of areas of this market that are incredibly overdone. There's a lot of good news already being priced in. Not saying we can't head higher from here, but if we're going to get a sustained move higher from these levels, I would actually like to see a pullback first. I would love to see us at a very minimum get a test of the 20-period moving average. That would be a great point to potentially find some support and springboard back higher. So we'll see if that happens or not. On the volume side, the volume is pretty light again here today. We've got 2 hours to go in the session. We've had 45 million shares trade today. It's actually a decent number compared to what we've seen earlier in the week, but it is monthly expiration. So it's a little bit misleading. The volume is going to be higher just due to expiration this afternoon. The volume it's been a struggle to hit 50 million shares. And that makes sense with so many stocks overbought. No one wants to get short here because price action just hasn't confirmed. Every dip has been bought. At the same time, it's really not a great point to initiate new long trades because the markets have already made such a great run. So we're just kind of left in that limbo. We could go either way here. And next week, I think, is going to be a very important week market-wide. If I open up my sidebar here, the VIX is at 21.75. We briefly broke the 20 handle last week. Friday afternoon, we actually closed slightly below 20 for the first time in months. We're right back above 20 here this week. So even though markets are a stone's throw away from all-time highs, there is some protection being bought here. We are seeing the VIX. Move back above 20. So that just goes to show, there is some nervousness out there. We've started to hear more about the overbought conditions in the headlines here this week, more so this week than what we've seen in the previous month. So be interesting to see how that plays out next week. So cautiously going into next week, I'm going to continue to focus more so on the credit spread side of things for a couple of reasons. Number one, they are more forgiving type trades. They give us multiple ways of making money on the trades. They allow us to put on positions with less capital. So it's a more conservative way to approach a market that's very slow and dull here at the moment. If we start to see some of those support levels break going into next week, I'm more than willing to adjust that whole idea, that whole approach, and go more towards the long calls, long puts. So let's talk through a couple of our trades that we closed out this morning on the overnight pop side of things. For those of you that joined us for our live webinar yesterday, we had talked through 2 live trades that were setting up for us in the afternoon. We talked about SPY and we talked about Tesla. Let's talk about how we manage those here today. So let's talk about SPY first. The trade that we put on here yesterday afternoon, we came in and we sold a $2 wide put spread with the options that are expiring here this afternoon. We sold a 390, 388 put spread. So I'm selling the 390 put, buying the 388 put at the same time. We sold the spread for 48 cents. We collected $48 per spread to put that trade on, and it tied up around $152 of our capital per spread. That's the minimum position size there. You can certainly take a larger position. I talked to a handful of you today that put on some decent sized positions yesterday, and they turned out to be some pretty nice returns. But at a minimum, $150 of capital per spread. We were ideally looking for a move to the upside. Now, I had some questions come in as far as why we were anticipating a move higher. Well, if we go back to that daily chart that we were just taking a look at a moment ago, we had found support yesterday right on top of that 8 EMA. So that was step number one. But then also, we know historically going into monthly expiration, you don't typically see very many large sell-offs. It doesn't mean it's impossible. It's not probable. You'll typically on expiration day see choppiness or a move to the move higher to the upside. So what we are looking at here is to slightly lean bullish going into today's expiration. And that put spread worked out really well. We actually closed it out here earlier in the session for 12 cents. It gave us a $36 profit per spread, 24% return on our capital overnight. If you're risking $500 per trade, which is what we track with our customers, it was a $108 profit overnight. The beauty there, if we take a look at the chart of SPY, it hasn't been the cleanest session, right? If I take a look at the 5-minute chart, let me pull that up here a second. So the 5-minute chart here today, first thing this morning, did we get a big move to the upside? It really wasn't a big move higher, but we didn't need it to be. The nice part about using a credit spread is I just need price to stay above that short strike. We sold the 390 put. I needed SPY to stay above 390. I didn't care if it only did so by a penny. As long as price stayed above that level, we were going to make money. Had I bought a long call coming into today, it would have been a very different story. Would have been more difficult to overcome the significant time decay that kicks in this close to expiration. But because we sold the put spread, we were able to close the trade out, book a 24% return on our capital overnight. Now, had some questions also as to why I didn't just hold to expiration. Why didn't I just hold right through the end of the day? The problem with that, especially in today's market where we can see reversals happen in the blink of an eye. It could be a tweet. It could be a news headline. Anything can happen. And I just don't want to have to sit there and watch the trade all day long. Because this morning we had a really nice profit. We closed the trade out for 12 cents. Had I held and price action sold off, Okay, we're off the highs here. We could very well see some further selling into the close today. I didn't want this trade to go from a really nice winner to a loser. It's going to require me to watch the trade all day long. I didn't want to do that. It was going to require me to keep my risk on all day long. I didn't want to do that. I'd rather book the profit while I have it, free up the capital for the next round of setups. Okay, now, fortunately, for those that did decide to hold on, price is still above 390. We're at 390.75. And if you want to hold into this afternoon, you can continue to make money on this trade. There's an extra, well, at the moment, there's 23 cents of premium in those options in that spread. So there's another 23 cents of profit potential between now and the closing bell. You just have to make sure price stays above 390. So we closed the trade out this morning, booked the profit, and moved on. The other one was on Tesla. Let's go ahead and take a look there. It was also another short put spread. Tesla, we have seen some selling pressure this week, which is the first time that we've seen that in months. I mean, Tesla's been one of the stronger names on the board now for quite some time. We were looking for a bounce higher. Now, keep in mind, when I talk about selling a put spread with this overnight pop trade, I'm not talking about this stock moving right back up to the highs and spending the next 4 or 5 days moving higher. We were looking for an overnight move. We put this trade on during the last 30 minutes of the session yesterday. We were looking to close it out in the first 60 to 90 minutes of the session today. So it's not a long-term hold. We were just looking for a higher open. That's exactly what happened here earlier in the session. Okay, the high of the session is up at 796, almost 797, $14, $15 higher than what we're seeing right now. So we sold this spread yesterday afternoon. We collected $1.55. $155 per spread. It tied up right around $350 of capital per spread to put the trade on. So very reasonable, regardless of account size. You're not talking about thousands of dollars to buy a call or put on Tesla. We're talking about $350. Now, this morning, on that move to the upside, we were able to close out of this spread for 60 cents. We bought it back for 60 cents. It gave us a $95 profit per spread. That's a 28% return on our capital overnight. Less than 24 hours. I took both of these trades. I had about 10 minutes into taking and managing these trades from start to finish. Wasn't requiring hours of research, hours of trade management, very easy setups to put on. Now, I say easy. They were profitable. So, I mean, it was great. Had these trades lost, okay, let's say they moved against us. Let's say this market, instead of opening higher this morning, let's say they open lower. Both of these trades are risk-defined trades. On SPY, the most I could lose was $150. Tesla, the most I can lose is $350. So it's a great way to stay active on some of these big stocks and ETFs without a huge time commitment, but also without a lot of capital. That's why I love taking these setups. Now, why did we hold? Why didn't we not hold into this afternoon? For much of the same reason that we talked about over on SPY. It would have required me to hold the trade all day long. Clearly, we can see what the market has done since this morning. We've sold off. Tesla is, $14, $15 off of the high. Had we held the trade, it's currently trading for around $1.37. It would still be profitable, but it'd be a very small profit. In most cases, what I have found, if we can close these trades out and book the profit during the first 60 to 90 minutes of the session, you're going to be far better off. In most cases, it's not going to pay off to hold right to the close and book the entire profit. I'd rather book the profit while we have it. That's what we have found to produce the best results for us over time. So really nice stretch there. That's 3 winners in. Let's see, I'm trying to pull up my spreadsheet here. 3 winners on the week for the overnight pop trade, combined with the trades from last week. We've had 2 perfect weeks in a row here. That's 6 winners in a row, and we've had 12 winners out of the last 14 trades. So after this week, our winning percentage has ticked up to 75%. We've got a 75% win rate on these trades going back into last year when we released the program. So it just continues to be that very reliable performer for us. Do I use it exclusively? No, it's just one tool in my toolbox. I do have some longer term positions on. We've talked about those positions here in recent recap videos. So we're not talking about using the overnight pop trade exclusively, but for me, I love it because it starts to generate that consistent source of income. If I have to hold my longer term positions for a period of a couple of weeks, couple of months, this allows me to generate more of an active source of income throughout the week. So Tesla, some of the individual stocks, we're looking at those overnight pop trades Thursday afternoon into Friday's expiration. SPY is unique because it has those Monday, Wednesday, Friday expirations. So we have 3 expiration cycles to work with each week. That just gives us more opportunity. So I love to trade SPY as well. And let me just check. All right. So now let's talk about some trades that are on my radar for next week. Let me go over to the 195-minute chart. This is the chart that I like to do most of my analysis off of for my entry and exit points. I like to use the 195-minute chart along with the 130-minute chart. So let's take a look at SPY. Price just kind of straddling that 8 EMA. It's been doing so all week. We have not been able to break away from that level. That's why we're at a very key point. We talked about it here a few moments ago. Going into next week, that level is going to be crucial. If we break away from that level in either direction, I think there's a very tradable move out of that pattern. When you start to see some of these individual stocks and ETFs get into these sideways patterns, it's what we call our coiled spring pattern. We know that SPY doesn't typically like to stay quiet for long. Tesla, Apple, Facebook, they're products that like to move. So when you start to see these patterns, you start to see a sideways consolidation phase for a period of days. SPY has just kind of been stuck right around 390 for the last couple of weeks. It's building energy for the next move. Out of the coiled spring, that spring is going to pop. We don't know when it's going to pop, nor do we know which direction it's going to pop in. But at some point, we're going to see this range break out, and we're going to see a very tradable move out of this range. So it's definitely on my radar for next week. I haven't done anything with long options at this point. No long call or long put opportunities. Would I be open to selling a credit spread? Sure. The reason I'd be willing to do that is because the time decay is working in our favor. If we just stay choppy going into next week, we can still make money from the credit spreads. So selling a call spread, selling a put spread, or maybe even an iron condor, definitely valid routes to go here. But I am flat at the moment. I'm potentially going to be looking at an overnight pop trade this afternoon for Monday's expiration, but I just haven't done anything as of yet. Just going to wait to see what happens around that 8 EMA here this afternoon. QQQ, the NASDAQ ETF. We mentioned the NASDAQ is the weak name out of the index products today. It's showing signs over the past week of some tired markets. You know, you take a look at Apple's down again today. Amazon's down almost $40. Last time I looked, Facebook was down. It is also down. So we've got a lot of these tech names that are tired. They did their job on the upside. We've had a phenomenal push to the upside, but they're tired. The problem is, anytime that we have seen any type of selling, it's been met with almost immediate buy the dippers. You know, and you take a look over the past couple of days, we've tried to break this 8 EMA, and every time that selling is met with immediate buying. So that's going to be another crucial level. I want to see price action break away from that level. In order for me to consider a long put position on QQQ, what I am looking for down at the bottom is for our trend strength histogram to flip from blue to red. That would have us going from buy mode to sell mode. We're close. We're sitting at 0.05. I mean, we're basically right on top of that zero line. Any type of selling this afternoon or even on Monday would have me interested in some long puts on QQQ. So that's going to be on my radar for next week. So currently flat on QQQ, but definitely has my interest going into early next week. IWM, the Russell ETF, continues to be just rock solid. I mean, we've had some selling here over the past week or so, but again, today up almost 2.5%. We have seen a recovery. We've seen the dip bought yet again. So going into next week, very similar to the other index products. I want to see price break away from the 8 EMA. Not thrilled if we start to break higher from here on the index products. I really don't want to chase this market higher. I'd rather see a deeper pullback first. So on IWM, out of the index products, as far as long put potential goes, it's probably my least favorite going into next week. I definitely prefer SPY or QQQ. In order for us to get a short trade on IWM, I want to see that trend strength histogram flip below the zero line. So just kind of in a holding pattern for the time being on the index products. Let's take a look at SLV. This is the silver ETF. We just got done talking about the coiled spring pattern. where you start to see sideways chop kick in. And you'll see this pattern quite a bit on the metals. You'll see it on gold. You'll see it on silver. When you take a look at this type of sideways pattern, we've been stuck right around 25 now for the last couple of weeks. It's just building energy for another move. Out of this sideways chop, out of that coiled spring pattern will come a nice break, and it'll give us a very tradable move. We've been talking about how we like silver on the upside. I still do. Going into next week, I still want this pattern to break higher. So I currently have my long call position is still on here. Jump over to the trade page. Over on silver, I am still in the March monthly cycle, the cycle with 28 days left to expiration. So if you're taking a look at, very liquid product, a lot of volume and open interest, a lot of different ways you can go here. If you're looking to put on a position here today for the first time, I like the 24.5 calls. They're very reasonably priced. You're talking about around $140, $145 per contract. That would give us a bullish trade on silver. Now, the coil spring pattern, the tricky part about that is we just don't know the timing of the break. I believe we're very, very close, but you've got to be cautious. Buying long calls here, the moment we put that trade on, the time decay is hurting us. So we want that move higher, and we want it as quickly as possible. So with 28 days left expiration, we've got a little bit of wiggle room there. We don't have to take action the next day or two. We can hold the position for the next 15, 20 days if needed, but definitely want to see that move higher sooner rather than later. And silver up 20 cents today, 0.8%. So decent start. We'll see if we get some continuation to the upside here next week. Let's go ahead and take a look at USO next. This is the oil ETF. Oil, along with a lot of other commodities, have been phenomenal on the upside. Historic moves in many cases on the upside. If you take a look at USO, you can see the latest run to the upside over the past month or so. Well, just to start February, we've gone from around 35 up to 41. Nice $6 pop to the upside. No surprise that we are starting to see some rollover to the downside here over the past session and a half or so. Down 0.7% here today, down 30 cents. That's a good start. Notice price action is trying to break below the AEMA. It's a great sign. We have a big air pocket between the AEMA and the yellow line is the 50-period EMA. We've got a nice tradable air pocket here if we start to break lower. So definitely on my radar for next week. And how would I play it? Let's go ahead and go back over to the trade page. Looking at USO, the long puts, I typically, with my long options, ideally, I want to go 1 to 2 strikes in the money, or I'm looking for a delta right around 0.60. In this case, on the put side, I'm looking for a delta around minus 0.6. It has me looking at the 41 puts. Okay, so it gets us slightly in the money, gets us a strike price in the money, decent liquidity, and you're still only talking about a couple $100 per contract. $200 per contract is what we're looking at currently. So that is a potential bearish trade going into next week. Again, when I talk about these positions, my time frame here, my typical holding time is anywhere from 3 to 30 days. So I'm not looking for USO to head lower for the next 3 months. I'm just looking for a tradable move to the downside in the near term. So long puts on USO, definitely on my radar for next week as well. And then finally, Zoom, symbol ZM. We're starting to see things open up a little bit, starting to see some of the COVID restrictions just loosen up a little bit. Obviously, we're still in a nasty pandemic. However, Zoom has seen a nice push to the upside over the past month or so. We have seen a move from down around 330 up to around 450 or so. It's a nice little move, and it did get overbought. We quantify that overbought condition because our pulse indicator plotted yellow here just this week. When it plots yellow, it indicates prices between a 1 and a 2 standard deviation move on the upside. It doesn't mean price can't head higher. It just means it's not statistically probable. Odds favor either a period of consolidation or a reversal in the other direction. We've talked about this pattern quite a bit in recent webinars. Take a look previously. If we start to go back in time, look what happened when we had those yellow bars on the upside. We saw some chop. We eventually saw the pullback to the downside. What happened when we had the yellow bars on the downside? We saw price action stabilize, and we saw a bounce higher. It's a very repeatable pattern. So now we have the yellow bars on the upside this week. Look what prices started to do since. We started to roll over here a bit. Very repeatable pattern. Doesn't guarantee a winning trade. It just means we're starting to stack the deck in our favor when we play this pattern. Because we're overbought here, because price action is below the 8 EMA, I'm taking a look at selling an out of the money call spread. It would allow me to put on a neutral to bearish position with a risk-defined trade. And as you'll see in a moment, we can put this trade on without a ton of capital. So here's what it looks like. Go over to the trade page. And we'll take a look at Zoom. So I was looking at a couple of different expiration cycles. Could we go out to March? We could. The March options with 28 days left to expiration. The problem with going out to March is if you go out to the out of the money call options, we have $10 wide strikes. It doesn't mean you can't trade $10 wide strikes, just more difficult. I would rather trade an expiration cycle that has $5 wide strikes or $2.50 wide strikes. And we would get those if we start to take a look at the weekly cycles. So the first one that I was looking at, let's go out to the March 26th weekly cycle. Those are the options with 35 days left to expiration. And I was taking a look at the 440, 445 call spread. All right, so what that would mean is I'm selling the 440 call and I'm buying the 445 call at the same time. Currently, it's trading for around $1.55 mid price. If we can get filled right there at $1.55, that is the max profit potential in the trade, $155 per spread. The beauty here, I mean, Zoom is a $400 stock. The options are pretty expensive. They're pricey. My maximum risk on the trade is $345. If I am dead wrong and the trade goes against me, the most I can lose is $345. Now, I should point this out too, because it's come up a couple of times in questions here the last few days. When I talk about the maximum risk being $345, a lot of times people will look at this and say, okay, you're risking $345 to make $155. How does that ratio make sense? The only way that I can lose the entire $345 is if I hold that spread all the way up to expiration and the trade moves against me that whole time. Is it possible? Yes. Will it happen from time to time? Yes, if you hold the expiration. However, you can close these trades out for a partial loss, and that's what we do in many cases. You're able to close it out for a partial loss. So at initial glance, you're saying that risk reward doesn't look great. It can actually be much better than that if you're managing the trade before expiration. Okay, so just keep that in mind. Now, how do we make money on the trade? We make money if Zoom stays below 441.55 over the next 35 days. The current price of the stock's at 417. Okay, we've got a nice $25 cushion here where we can be dead wrong. The price can move higher and I still make money. We're not expecting that big move higher because the market's overbought. I don't care if price action moves around back and forth in here over the next 35 days. As long as price stays below 441.55, we make money. Higher, lower, sideways, doesn't matter. We also make money from time decay adding up, which it will every single day, and also from volatility decreasing if that happens. So now we got 5 different ways or 5 different combinations that we can have to make money on this position. So it's a nice way. I love to use the credit spreads, just if for nothing else, just from the cost savings perspective. Because if you take a look at Tesla, Zoom, Amazon, Google, they're expensive. The options are very pricey. Using these spreads are a way to better control your risk. Yes, you're going to give up the home run profit potential. You're going to have a higher profit potential with the long calls, long puts. But if I buy a long put here on Zoom, the only way I make money on that trade is if Zoom moves lower, and it does so quickly. I'm not convinced that that's going to happen here quickly. I could certainly see that sideways pattern kick in because, again, every dip has been bought here, right? So this is just a more forgiving trade. How would I manage it? The $1.55 is the max profit potential on the trade. Sorry, guys, trying to turn some alerts off. The only way that I can book that entire profit is if I hold all the way up to expiration. That's not something I typically want to do. I would rather go ahead and close out of the trade when I can keep between 50 and 75% of my max profit. Okay, so whatever you collect to put that trade on, that's going to be your max profit. So if you can close out of the trade, keep between 50 and 75% of your max profit, that's what we're looking for. So let's just say, price action is kind of bouncing around in here. So if we get filled at $1.50, if I can get if I can close this trade out 75 cents or so, I mean, that would give us 50% of our max profit. So anytime over the next 35 days, if we can close it out in that range, that would be acceptable. All right, and let's just take a quick peek. I mentioned I have alerts going off, and I assume the market was moving, and it is. So I have all these alerts set just to notify me. I'm not always able to track markets from opening to closing bell like a lot of you can. So I set a lot of alerts for myself, and I have those alerts going off here, notifying me that we're starting to break lower. So right down near the lows of the session here as we go into this afternoon. So good to see. The NASDAQ, the S&P are weak. So definitely good to see. So let me share with you before we wrap up. So we've been talking quite a bit about our overnight pop trades. I've been spending a lot of time in these recap webinars, walking you guys through how we've been taking and managing those trades. I put a link up on the screen. It's netpicks.com/0221 OPT live. I know it's a mouthful there. But that webinar will walk you through how you can gain access to those overnight pop trades. We do the research for you. Those are trades that we're taking every single week. We take them in our own accounts. We take them with our customers. We're active with that setup every week. We look for between 2 and 4 trades each week. We do the research. We send you the trade alerts with the exact recommendations, the pricing, the instructions, everything you need to take action on those trades. The webinar that I have up on the screen will walk you through more details on what the program looks like and how you can get access to it. So we'd love to have you review that webinar. If you have any questions while you review it over the weekend, feel free to email me directly, mike@netpicks.com. I'd love to connect early next week, and we can talk through any questions you might have. All right, so if you have any questions on markets I have not taken a look at here today, if you have any questions on the overnight pop trades that we closed out this morning, again, for those of you that joined us late, we closed out of 2 additional winners here today. That's three more winners on the overnight pop trade here this week. It's had 2 weeks in a row of perfect performance, so it's done really well for us. Again, our winning percentage is up to 75% going back to last year. So we'd love to have you join us for our next round of setups going into next week. All right, guys, I'm going to start to wrap up for the week. Enjoy your weekend, everybody. We'll be back here next week. We do these sessions every Wednesday and Friday. So we'll do our midweek recap, midweek update next Wednesday. So we'd love to have you join us if possible. All right, again, enjoy your weekend, everybody, and we'll talk to you guys next week.